Good morning. Let's see. I'm trying to see how many of you there are. Oh, well, I won't worry about that for now. Good morning. My name is Heather Liston. We're going to talk about tax strategies for the real estate professional. And this is me. Um, I am a certified financial planner. I am also an enrolled agent. And for those who aren't familiar with that term, it means I'm a tax specialist. Enrolled agent, or EA, is a designation provided by the IRS. It means I took a series of tests about 10 years ago, and I have to do significant continuing education every year. So an enrolled agent is one of three types of people who can not only fill out tax returns, but can also represent people in front of the IRS. That's CPAs, enrolled agents, and attorneys. So I hope that gives you a little context on that. I'm peeking in the chat right now because I think I already see some things in chat. Let's see. Oh, yes. Okay, good. What the chat says is, first of all, good morning and welcome, which I will echo. And the other thing is, it's letting us know that we are being recorded. That's okay with me, and I believe you will get a recording afterwards if you want one. Also, I will let you know that at the end of the program, I am going to send Elsie my slides, which she will share with you. So you don't need to ask about that. If you do have questions at any point, there's a couple of things you can do. You can type a question into the Q&A on your screen, and I will try to look at that frequently to make sure I'm not missing things. Or you can also click the raise hand button, because it might be nice if we could actually hear from you in person. If you click raise hand, we will try to call on you and let you actually speak, so you don't have to hear just me all the time. So again, I'm a certified financial planner, I'm an enrolled agent, and I have a company here in San Francisco called Clarity Financial. I do financial planning on a fee-only basis, and I also do taxes. Now, my tax roster is full. I'm not here to solicit your business. If you need a tax professional, I hope you can find one. And I have a few ideas at the end of this presentation about where to find one if you're looking. So I'm not here to advertise my services. I just want you to know who I am. My website is clarityfinancialca, as in California.com. There are a few resources there that you might want to go get on your own at some point. Okay, so important disclaimer. We're going to be talking about general examples today. Tax laws are complicated and they change frequently, unfortunately. It can be quite confusing. And so neither I nor the Orange County Realtors can give specific advice about your personal situation. We will do our best to answer your questions as much as possible, but your situation is unique. Sometimes the examples I give may not apply exactly. So if you do have a tax preparer or a financial advisor or anybody else, always discuss your financial decisions with them. You can't just say, oh, some lady on a webinar said it was okay. The IRS isn't going to buy that. So you need to make sure that everything applies to your personal situation. Today's topics. There are so many things we could talk about, but I decided to focus on basically three areas. One is what's new in tax laws, because some significant things changed. There was a new tax law passed in July of 2025, so about 6 months ago. It changed well, of course, it was big. It's right there in the name, the One Big Beautiful Bill Act. It was big. There's a lot of stuff in that new law, but there are a few specific things that affect most of us that I want you to know about, that you can actually do some planning around. Then the other two big topics are, what is a real estate professional? Now, I realize you may be sitting there thinking, I'm a real estate professional. Who's she to tell me? But the reason I bring it up is it is a term of art under IRS rules. There is a thing called a real estate professional. And if you qualify as a real estate professional, various tax laws are different for you. It's a very specific area of the law, and it can be useful and valuable. So we're going to talk about that. What is an official real estate professional? And then we're also going to talk about tax issues related to being self-employed. I am self-employed as a financial planner. I know that many of you are probably self-employed. And so we're going to talk about what that means, how that works, what tax advantages there are to that. So I now have some questions for you. And I wonder, let's try this with the raise hand feature if possible. How many of you are a realtor? Do I see any hands? I don't think I do. Oh, yes, I do. I see 10 at the moment. 10 raised hands for realtor. Good. And let's see. How many of you are self-employed? Yeah, put down your realtor hands if you would. And then raise your hand if you are self-employed. Good. I see that ticking upward. Okay, I think I see at least 10 of those also. Also, I want to mention that it is only it's only 10:05. So we have jumped right in, and I wouldn't be surprised if a few more people join us. Elsie told me, don't mess around, go ahead and get started, which I think is the right and fair thing to do. You guys are prompt, you show up on time, you deserve to have things start on time. But I just want you to know there might be more people joining us. So, all right, so we have self-employed people, we have official realtors. Now, how about this next one? The fourth question on my list. Who is self-employed and also has a regular W-2 job? Maybe you work for somebody, maybe you work for another realtor by day, but then you sell some houses on the side, or you sell your jewelry on the side, any type of or you drive for Uber, any type of self-employment in addition to a job is an interesting combination. Okay, at the moment I see only one of those, but I wouldn't be surprised if there are others. And by the way, I hope you have found the raise hand feature. I know if you're, oh good, yes, there's another one. If you're not used to the whole Zoom setup, I realize it can take a few minutes to get oriented. So related to that, I just want to say again, if you have questions at any point, we asked you to put them in Q&A. I'm just realizing my screen has changed. Okay, good. Yeah, I can see the Q&A and I don't see anything in there yet. I see someone has a raised hand right now. Is that, and Maddie, is that left over from my questions? Or if you actually have a question, please go ahead and ask. Okay, maybe that was just left over from me. Okay, and all right, thank you. Someone wrote, no question. Okay, good. But do feel free. We have 2.5 hours today. And so it's not a problem if there's something in particular that you want to know about, or if you don't understand something I say. I would welcome your feedback along the way. Okay, other things we're going to talk about, as sort of an overview. I already asked you how many people were self-employed. Sometimes people aren't even really aware that they are self-employed. When you're self-employed, you are a business owner, even if it's just you. Let's say you drive a Lyft car on the weekends and you get paid as a 1099 person. If you were driving for Lyft, I believe you would get a 1099. Some jobs you don't get anything. Like maybe you do some handyman work in the neighborhood. People pay you in cash. They don't bother to send you a 1099. You're still a business person. You own that business. You have taxable income. You need to report it. You're self-employed and you own a business, whether you kind of thought of it that way or not. We're going to talk about types of business entities, and specifically, if we have time, which I think we will, we're going to talk about QBI for real estate professionals. QBI stands for Qualified Business Income, and that is a special deduction that was invented at the end of 2017. It took effect in 2018. It was originally supposed to expire this year at the end of 2025, but it has been extended. So the Qualified Business Income deduction can be very useful. Not sure if you've heard of that before, but it's a valuable thing for those of us like me and many of you who are self-employed. Other things related to being self-employed, we're going to talk about filing business tax returns, when you use Schedule E versus Schedule C. Real estate professionals, as I mentioned, it's a special category. And the main thing that being a real estate professional does for you, if you meet the definition, you get to call your real estate income active versus passive income. So we're going to talk about what that means. We'll talk about business expenses, how to deduct them, and how they're different from personal deductions. Okay. All right. So I said we'd start with what's new in the tax code. This is not just for real estate people. This is for everybody. A few new things that I think are particularly relevant. And just a second, I think I saw something in the Q&A. Yep, I do. Oh, okay. Somebody asked the question everybody always asks. Will we receive a copy of this? So the answer is yes. At the end of this presentation, I'm going to clean up my notes a little bit based on any feedback or anything that changes during, and then I'm going to send a copy to Elsie and she will make sure that you get my notes. So please, you don't have to ask that again. I promise you I will send the notes afterwards. So if you don't want to take your own notes, that's fine. So we're going to talk about what's new. This is what's new in the tax code as of the new tax law that passed in July. And one of the interesting things is some of the things in that code took effect immediately and apply to 2025. Some don't apply until 2026. So some are still a planning opportunity. The ones that I think may affect us are there's a new senior deduction. There's changes in the charitable contribution deductibility. The third one there can be very valuable for Californians in particular, the adjustment to the SALT limitation. SALT stands for state and local taxes. Now, we don't usually pay local income tax here. Like I don't pay a San Francisco city tax, but we do pay a lot of state income tax in California. And if you own a home, you may pay a lot of real estate tax. For the past 7 years, you were only able to deduct up to $10,000 for both of those types of tax combined, your California state income tax and your real estate or property tax. For a lot of Californians and other people in high tax states, that was a big deal. That really limited your tax deductions. For some people, that $10,000 is now being bumped up to $40,000. Could be very valuable. The last two have to do with retirement plans. There is a new extra catch-up amount you're allowed to put into your retirement plans, your 401k, your 403b workplace plans, if you will be age 60 to age 63 at 12/31 of this year. And then finally, a new law related to the catch-up contributions for people who have a 401k or other workplace plan. That now has the catch-up, if you are of a certain age, has to, I'm sorry, not a certain age. This catch-up contribution has to be a Roth if you are at a certain income level. So each of these, most of these have income limitations. And of course, they're not all the same. Tax laws are always complicated. So fortunately, we have slides because it's hard to even keep them all in my mind. First, the new senior deduction. Officially, this applies from 2025 through 2028. Very limited period of time, may or may not be true. The laws change all the time. Could very well be that Congress or the IRS or somebody, and as 2028 draws to a close, says, "Hey, everybody likes this. Let's keep doing it." We don't know. But officially, it's just for 3 years. Now you'll notice it says 2025. That year, it's already over, but we haven't done our tax returns for that yet. So it's something to be aware of. If you were 65 or older as of 12/31/2025. So if your 65th birthday was more than a few months ago, you are eligible for this. It's up to $6,000 per taxpayer. So if you are married filing jointly, that's a $12,000 deduction. That's a lot of money. It could be very valuable, but it does phase out with various income levels. So if you are filing single and your adjusted gross income is more than $75,000, you cannot get the full $6,000 deduction. If it's more than $175,000, you don't get any of this. And if you're married filing jointly and your total adjusted gross income is above $250,000, you don't get this $6,000. By the way, this abbreviation MAGI, M-A-G-I, that stands for Modified Adjusted Gross Income. Later, when we get more into the depths of tax returns, I'm going to show you where that, well, actually, MAGI never actually appears on your tax return. I'm going to show you where adjusted gross income, or AGI, appears on the tax return. It's a very important number, adjusted gross income, because a lot of things depend on it. Essentially, your adjusted gross income is your total taxable income before itemized deductions or your standard deduction. So your adjusted gross income is a higher number than your taxable income. And your adjusted gross income affects a lot of things. So it is kind of important to know what's your adjusted gross income. Again, later I'm going to show you an actual picture of a tax return and you can see where that line item is. It'll be on the front page of your 1040. There will be a line that says adjusted gross income. That's a very important number. So again, if your adjusted gross income is below 150,000 and you're married filing jointly and you're 65 as of the end of last year, you're going to get a pretty big discount on your taxes, an extra $12,000 for married filing jointly as a deduction. This is kind of a big deal. And it is a planning opportunity because we have the ability within limits, we have the ability sometimes to manipulate what our adjusted gross income is. Again, we're going to look at more details of this later, but some of the ways you can change that are if you contribute to a pre-tax retirement plan that lowers your adjusted gross income, in addition to lowering your taxable income. So if you have access to a 401k or a traditional IRA, or if you're self-employed and you're contributing to a SEP IRA or a solo 401k, all those can be pre-tax. They can lower your adjusted gross income. So then you not only get the benefit of that retirement plan, you also may trigger $6,000 to $12,000 in additional deductions just because you lowered your adjusted gross income. Now, I'll just mention, in the rest of the country, $150,000 is very good income. In California, I know you live in a high expense area. These are not outrageous amounts. It's very common that people make above 150 or above 175 if they're single. Very common. These are relatively low income ranges in the California area. They're not low income ranges in the rest of the country. So you may not qualify for this, but it's worth knowing about. Another important fact, this new senior deduction is not available if you are married filing separately. Married filing separately in general is a bad status, and there are not very many situations where you'd want to do that. But occasionally people come to me and say, oh, we just thought we'd file separately and it'll keep our things separate or whatever. It's usually a very bad idea. And one of the reasons it's a bad idea is you're not eligible for any tax credits, and also not for certain things like this. Also, when you're married filing separately, you can't contribute to IRAs. So it's important to be aware of that. That is usually a bad status. If there's some reason why you think you should be married filing separately, I'd say talk to a tax professional, make your case, let them explain the ramifications. But in general, don't think it's a good idea because it's usually not. Now, this additional $6,000 per person, it's in addition to your standard deduction. For 2025, if you're single and over 65, which is the only people this new senior deduction applies to anyway, you're going to be getting a standard deduction of $17,750 already. And then you get the $6,000 on top of it if your income is at that level. In 2026, the standard deduction went up. Standard deduction is tied to inflation, so it goes up automatically almost every year. So let's say you were married filing jointly in 2026, you get your total standard deduction of $32,200, plus if you're married filing jointly and you're both over 65, that's going to be another, when I do this in my head, another $3,300 plus $12,000. Again, kind of a big deal. So you may want to be aware. You can't change much for 2025 at this point, but for 2026, you may want to be aware. Now, if you make $1 million a year, don't even think about this. It's not going to happen for you. And congratulations on making $1 million a year. But if you are going to be kind of in this range, you may want to be aware of it and see what you can do to manage your deductions, manage your income so that you do fall within the range where you get this extra deduction. I'm going to pause a minute and peek in the Q&A again to see if I'm missing any questions. Sorry, I'm moving my cursor around on the screen. I'm sorry. Somehow the way that my Zoom is showing up, the Q&A disappears. Okay, I don't think I see anything there. I think I see one more thing in. Okay, got it. All right, again, do feel free to ask questions. I would be happy to talk about what you want to hear about. So do feel free to pop in, either raise your hand or put a question in the Q&A, and I will try to keep remembering to check. All right, next deduction, charitable contribution changes starting in 2026. You'll notice the other one, the senior deduction, started in 2025. The charitable contribution changes start in 2026, which is fine because you couldn't go back and change this for last year anyway. this one is officially permanent. I put that in quotes because, as you may know, with our government and our tax laws, nothing is actually permanent. Things can change all the time. But theoretically, we're going to have this forever. I like this one because I do not itemize personal expenses. Usually people do not itemize unless they own a home and have mortgage interest. Otherwise, usually it's better to take the standard deduction. If you take the standard deduction in the past, you usually do not get to deduct your charitable contributions. You might remember during COVID, when there were a lot of sort of emergency things put in place in, I think it was 2020 and 2021, we could deduct about $300 each, even without itemizing, if we gave to charity. This is even nicer. You're not itemizing, and you take the standard deduction, you can contribute $1,000 to qualified charities and take a deduction for that. If you're married filing jointly, it's $2,000. Now, this applies only to cash gifts made to qualified public charities. When we say cash, by the way, doesn't mean it has to be green dollars. Cash means you write a check, you put your credit card number on the website, something like that. What it means is it does not include giving your old shoes to the Goodwill. That's not a cash donation. And it does not include giving away appreciated stock. Appreciated stock is still a good way to give if you have large charitable goals, but you would need to itemize your expenses in order to take advantage of that as a tax deduction. But for most of us little people who can't afford enormous contributions anyway, this means this $1,000 is donations you might make to your church. Let's say you put $10 in the collection plate each week. If you keep track of that, that will become deductible. Or if you write a $50 check to your kid's school for a fundraiser, or you give to the ASPCA, any sort of normal charities, you contribute to the Sierra Club. Actually, that's not a perfect example, the Sierra Club, because I don't mean to go off on a tangent, but that's an organization that does a lot of ordinary charitable work, also does some political lobbying. So the Sierra Club, just FYI, has split into two officially different organizations. So because political contributions are not tax deductible. So in that case, if you were giving the Sierra Club and you wanted a tax deduction, you make sure to give to the portion that is tax deductible. So political contributions are not tax deductible, but most ordinary things that you think of as deductions are. Your church, your food bank, that's a big one, especially lately. Food banks have become very popular. All those kinds of normal contributions, animal shelters. Now deductible starting in 2026 up to $1,000 a person. I really like this because it encourages us to do what we wanted to do anyway, which is be nice to our community. I'm going to give to the Civic Theater that I grew up with as a child. That was very important to me out in Indiana. I'm going to give to my local public library, which does wonderful presentations and a few other things. It's kind of nice. It gives us a chance to think of ourselves as philanthropists. Next change. This one is important. This one is valuable. Officially, this lasts from 2025 through 2029. Again, who knows when it will change again, but 2025 is important. That means you're probably started right now on working on last year's tax return. This does apply to last year's taxes, to 2025. So it's very important to understand it now. It only applies to people who itemize deductions. But if you own a home and you have mortgage interest, you probably do itemize deductions. From 2018 through the end of 2024, as I said, you were only allowed to deduct up to $10,000 for the combination of California state income tax and property tax, no matter how astronomical they were. You could only deduct up to $10,000 per return. Now, you may be able to deduct up to $40,000 per return. This could be a very big deal. This could also push some people who didn't itemize into itemizing. So it is something to definitely be aware of. Now, this phases out if your adjusted gross income is above $500,000. And interestingly, this is the same, the phase out range for income is the same regardless of whether you are single or married filing jointly. So unfortunately, this is a new kind of marriage penalty. It means, like, let's say you were two single people and you each made $200,000 a year in adjusted gross income. If you were single, you could each probably get this full deduction of $40,000. If you're married, no, wait, I said you each made 200. Let's say you each made 300. Now you're married, you're making 600,000, and you do not probably get to deduct it because 600,000 is your adjusted gross income and you're phased out. I don't want you to make marriage decisions based on this, but I want you to be aware of it. There is kind of a marriage penalty in here. But the difference between deducting $10,000 and deducting $40,000 is a very big deal. So it's important to be aware of it, and also to be aware that this is one of the things that's basically retroactive. It does apply to your 2025 taxes. So it's possible you're in for a nice surprise with your tax return this year. Next new issue, there's a new extra catch-up for what I call young old people. Now, catch-up, first of all, what I'm talking about is contributions to retirement plans. So first of all, we have this regular over 50 catch-up. You may have heard that term. That's been around since 2001. In 2001, anybody who was at least 50 years old could start contributing extra to their retirement account. So for example, the 401k contribution amount that you are allowed for 2026, for most people, I believe it's $24,500. That's how much you can put in a 401k if you have a regular job, or in your solo 401k as an employee deferral if you are self-employed. If you're under 50, $24,500 this year. If you are 50 or over, it's $32,500 because you get to put in an extra $8,000. Now, as I said, this over 50 catch-up has been with us for a while. The amounts change a little bit most years because it is tied to inflation, but they used to go up only in $500 increments. So this one's a little weird. The fact that in 2026, if you are contributing to an IRA, traditional or Roth, in 2026, you can put in an extra $1,100 if you are 50 or over. Not a big deal. Last year, as you saw, it was $1,000. I just think it's a little interesting that sort of this unusual number now, $1,100. Okay, so these are the over 50 catch-up amounts that are additional amounts you're able to save in retirement funds. What's new is starting in 2025, there's this super catch-up, and it only applies to people who are age 60 to 63. That means if you were at least 60 by 12/31 of 2025, you can put in extra money for 2025. If you're at least 60 and not more than 63 at 12/31, 2026, you can put in this extra amount for that. So for 2025 and 2026, this super catch-up gets you to 11,250 as a catch-up. That's not in addition to this 8,000 or 7,500. It's 11,250 instead of $8,000. So I may have the math in here, but I'm going to do it again. So 24,500 is the normal amount that a young person can put in a 401k in 2026. If you happen to be right in that little range from 60 to 63, you can put in another 11,250. That gets you to 35,750. Now I realize some people may be saying, that's really funny. Where would I come up with an extra $35,750, right? I know we need take-home pay to pay our bills, but I do always push people towards the maximum retirement savings. There are so many good reasons for maximizing your retirement savings. One is we want to retire someday, right? We want this systematic savings to be building up so we don't have to work forever. But another reason we want to maximize these as much as we can is that this does affect our taxes. Like if you are able to put $35,750 into a pre-tax account, a 401k account or a 403b or whatever your pre-tax retirement account is for 2026, that's going to reduce your taxable income by $35,750. That's a big deal. I mean, not only does it's always good to have tax deductions, but it also means this year in particular, when we've got these new tax deductions that have income limits on them, it's a big deal. If you put $35,750 in your 401k, it might bring you down under that threshold where you get the new $6,000 senior deduction, or you get the new extra $30,000 in SALT deductions. So this is an opportunity to legally manipulate our taxable income. All right, this is just more details about the new deduction. I'm peeking. Okay, good. We have a question. Somebody says for SALT, what $40,000 were you referring to? Property taxes or mortgage interest? Taxes, okay? SALT stands for state and local tax. So that's how you remember it. The T is for tax. So that SALT deduction, it does not refer to mortgage interest. Your mortgage interest is on a separate line, and that's fully deductible. There's not an income limit for deducting mortgage interest. There is currently a limitation based on the value of your home. If your mortgage is for more than $750,000, you might not be able to deduct all of your mortgage interest. But you are making an important distinction here that can be confusing to a lot of people. Mortgage interest, fully deductible on Schedule A for itemized deductions. Property tax on Schedule A gets lumped in with California state income tax. So the SALT deduction refers to the combination of your state income tax and your property tax. And again, both of those in California might be very high. So it might be quite valuable for you to be able to raise that deduction from $10,000 to $40,000. Thanks for that question. That's exactly the kind of thing that's helpful to a lot of people. So everyone feel free to keep putting those in. And I'm going to, again, to look at the Q&A. You know what? It does take me an extra minute to get the Q&A to show up. So even though Elsie and I both told you to put your questions in Q&A, if you don't mind, maybe start putting them in chat. Sorry to change something, but I think I can see the chat faster. So please feel free to put your questions in chat. Moving on. And this is the final of my what's new section. There is this new thing starting in 2026 that says if you are high income. Now, the income limits for everything in the tax code are different. I wish they'd just come up with some levels and say, okay, you're rich if you're over that, you're poor if you're under that, but they don't. Every part of the tax code has a different amount tied to it. But for this purpose, highly compensated employees are people whose income was above $150,000 in the prior year. Now, again, in California, that's really not a particularly high income. But if your income, and notice it says employees, if you are self-employed, you're not an employee, okay? You're an owner. But if you are an employee, that means someone who gets a W-2 and your income the prior year was above $150,000 and you're contributing to a 401k, your catch-up contribution has to be made as a Roth type. First of all, quick review of what does that even mean? What's a Roth? There are two basic types of retirement plans. There's pre-tax, which we often call traditional. They've been around longer. They reduce your taxes right now when you put money in. Then there's Roth type accounts, and you may have a Roth 401k, a Roth 403b, a Roth 457. You might have a Roth IRA. There's usually Roth versions of almost every type of retirement plan. With a Roth plan, you do not get a tax deduction now, but money that you put in that Roth grows tax-free for the rest of your life and 10 years beyond. So any earnings, dividends, interest, capital gains on that money is never taxed again. So both types, pre-tax and Roth, are incredibly valuable. And so this is nothing to feel bad about, nothing to worry about. Putting money into a Roth account is actually a great idea, but it is important to know that your catch-up contribution, that means that extra $8,000 a year, or if you're 60 to 63, the extra $11,250, that has to be made as a Roth. No problem. If you have a 401k and you're able to maximize your contributions, fine. You can just go ahead and put the first $24,500 into pre-tax, put the catch-up into a Roth. It's fine. It's just that right now, this is the law. You have to do that if you are considered highly compensated. Okay, two more points. This new mandatory Roth for catch-ups does not apply to IRAs. It only applies to workplace plans. Workplace plans is a generic term for 401ks and 403bs and 457s. All right, next topic. So those were all the things, they weren't all the things that are new in the tax code, They're all the things that I think are affecting most of us in the tax code that are important to be aware of, both for your 2025 taxes and beyond. Let's see, I see someone put up a hand. Sahar, could you go ahead and try to ask your question? Wondering if I need to unmute you. I think I do. Are you able to ask your question? Let me see. Oh, I see something in the Q&A. Oh, somebody says no more goodwill deduction. Oh, fair question. Okay, what's up with that is if you itemize deductions, that means you do not take the standard deduction, you fill out Schedule A. If you itemize deductions, you can still deduct your goodwill contributions, and you can deduct any legitimate charitable contributions, including ones you make with appreciated stock. You can still deduct those the same way you always could. What's different is that you now can deduct cash contributions if you are not itemizing. But goodwill deductions are still deductible the same way they always were if you are itemizing. And then someone says, what's the maximum on Roth contributions? Let's see, the maximum on Roth contributions. So first of all, there's two different ways to think about this. There's your 401k workplace plan and there's an IRA. If you are making contributions to a 401k workplace plan and your plan has a Roth component, most plans do right now, you could put all of your deferral into the Roth, which would be, if you're under 50, that's $24,500. You could put that all in Roth or all in pre-tax. If you are 50 or over and you make more than 150,000 a year, you can put the first 24,500 in Roth or pre-tax, but the last 8,000 of catch-up you need to put into the Roth. With IRAs, let's see, do I have that amount here? I think I do, because they change every year. Oh, I don't have it here. Okay, I believe that in 2026, the limit for a Roth IRA or a traditional IRA, that the limit for an IRA in 2026 is $7,500 if you are under 50, $8,600 if you are over 50. That's $7,500 plus this $1,100 catch up. So that IRA, now there are other limitations. There are income limits on who can contribute to an IRA, but that $7,500 or $8,600, you can put that in pre-tax or Roth or any combination. So basically, your question, what's the max on a Roth contribution? Usually the answer is pre-tax or Roth, any combination that gets you to the total max. What's new is that catch-up contribution in your 401k has to be Roth. By the way, that's not a bad thing. Roth accounts are great, okay? Roth accounts are great. Pre-tax accounts are great. Nothing to feel bad about. Just be aware. Okay, and I see a hand up again. Let's see. I'm clicking a button that says ask to unmute. I'm not sure if I have the power to unmute you or if you have to. But Sahar, if you want to ask a question, would you try to unmute yourself and ask it?
Yeah, sorry. I think I did that by accident. So,
Okay, well, that was nice to know that it works. So if you would like to ask a question live like that, feel free to raise your hand. If not, feel free to put questions in chat and we'll continue monitoring that. All right, so that was the end of our section on what's new this year that I think is going to affect you. Next topic, you're in business. So this is for self-employed people. And we noted at the beginning that quite a few of you are self-employed, as am I. So it's important to me to know about all these self-employed issues. And also, those of you who have a regular day job, you may want to be self-employed either in the future or on the side. Both are perfectly fine. You can have a regular day job and earn a little money on the side as a business person, totally fine. And then these rules apply to you. So the reason I write you're in business really is a lot of people don't really realize they are a business owner. As soon as you do anything with a profit motive that's starting to earn you some money or that you hope will earn you some money in the future, you're in business. That applies to a lot of things. So if you are self-employed, you are a business owner. People often say to me, oh, no, I don't own a business. I just drive for Uber on the weekends. Or I don't own a business. I just like arrange flowers and people pay me for that. That's a business. You're a business owner. Even if you're being very modest about it, you're a business owner. So you're in business if you're engaged in an activity with the intention of making a profit. I find that always kind of interesting that the IRS wants to get inside our intentions. And obviously, they don't know, the government doesn't know exactly what you're thinking and what you're feeling, but it's important whether you have the intention of making a profit. What that means is some people have a business, some people have a hobby. It's not a fine line what the difference is, but it kind of matters because hobby expenses are not tax deductible. Business expenses are tax deductible. Now, how do we know whether you have a hobby or a business? One test, it's not definitive, but it's a test, is that if you earned a profit in 3 of the last 5 years, the IRS has an assumption that you probably are in business. If you earned a profit in 3 of the last 5 years, doesn't say how much profit, even a little profit. If you did not earn a profit in 3 of the last 5 years, there is a presumption that it's a hobby. But notice I did not say there's proof that it's a hobby. It's not proof. It's a presumption. Like the IRS and the government, they can't force us to be good at our jobs, right? Maybe you are writing a memoir. I work with one client who has gotten, she's gotten a contract from a publishing agency. She hasn't made any money yet, but she's been working on this memoir. She takes it seriously. She hired a professional editor. She works constantly on it. She got a deal with the publishing agency. This is not a hobby. This is a serious person doing something with the intention of making a profit. Now, the way books work, you don't get paid when you start working on it, right? You might work on it for several years before you actually get paid. That's fine. She has done other things to demonstrate that she is serious about her business and she has an intention of making a profit. On the other extreme, I work with one woman who makes jewelry. A lot of women make jewelry. A lot of people make jewelry. It can be a lovely hobby. Some people do it just as a hobby. Some people do it really intending to make money at it. This particular woman was hoping she could deduct her expenses. But I talked to her about it. I said, do you make any money selling your jewelry? And she said, oh my goodness, no, I give it to my friends. And then she said, well, I sold some. I said, great. Who'd you sell it to? She sold it to her son. Yeah. And then she said, really, he just reimbursed me for materials. This person really does not sound like she's in business. She sounds like someone who loves making jewelry, who loves her friends and family. All that's very good, but that sounds like a hobby. So you'll notice I brought up several issues that are not strictly, did you make money or not? Maybe you're not good at what you do. Maybe you're trying really hard to start a business in anything, but people aren't hiring you and you're not doing well at it. If you're working at it and you're doing what you need to do to be a serious professional, and you hope to make a profit eventually, you're probably in business. Now, the business that I think most of you are in, probably not so vague, right? I don't think you buy, well, maybe you do. Maybe you buy real estate just for fun. But I think a lot of the work that you do is hard work. You do it with the intention of making a profit and supporting your family and it being your business. So acting serious is actually one of the things that makes something a business and makes your business expenses tax deductible. Go ahead. Okay. I thought someone had a question. Someone may have unmuted by mistake. Let me see if I can control it. Yes. Okay. I think I muted that person again. I'm looking in the chat. Oh, when I was talking about IRAs a few minutes ago, and I said if you are under 50, you can contribute $7,500. Someone says, I thought it was $7,000 for IRA. I believe it was $7,000 in 2025, and I believe it's $7,500 in 2026. Those things tend to change every year. And by the way, at the end here of my presentation, I do have some charts that show exactly all those amounts. I don't want to jump down there now, but we will take a quick look at that before we end. Someone says, I'm confused, haha. Uh-oh, I'll try to unconfuse you. Let's see. Oh, someone says this 11,500 of catch-up. Is that for the 401k or regular Roth IRA? The answer is that special super catch-up for people who are age 60 to 63 only. It's $11,250, and that is only for 401ks, workplace plans. That is not for IRAs. So thank you for those questions. Yeah, 401ks, not IRAs. Okay, I'm going to keep monitoring the chat, so do keep putting things in there. Back to who's in business. If you receive a Form 1099 at the end of the year, you are a business owner. Okay, a 1099, as you probably know, is different from a W-2. When you have a job, when you're an employee, you get a W-2 and taxes are withheld. If you work for someone as a freelancer or a contractor, they're going to send you a 1099. They're probably not going to withhold taxes. They're just going to say, I paid Heather $5,000 to fix my roof this year. Or I paid Heather, a total of $11,000 for counseling services, whatever it is. If they send you a 1099, there's no taxes withheld, you own a business, even though you didn't think about it that way. And even though you didn't set up an LLC or something, you do not need to do that. We'll talk a little more about those specific business structures lately. But if you receive a 1099, you're a business owner. You're self-employed. If you work for someone and you get paid and they do not give you either of those forms, a W-2 or a 1099, you are still a business owner and you are still required to report your income. Or if you think of yourself as a freelancer, you're a business owner. Now, this one confuses some people. They say, well, if I earn money, shouldn't I get a 1099? The answer is, if you worked for someone and they paid you more than, I think it's still $600, it's been $600 for years, may have gone up a little. But if they paid you more than $600 during the year, they are supposed to send you a 1099. Sometimes they don't. Not everybody gets around to it. Not everybody is organized as you are. If they don't send you a 1099, they could get in trouble, but that's not really your problem. Your problem is you need to report that income whether you received that form or not. The fact of whether they send you the form, that's not the biggest deal. It's helpful, helps you organize it, but you have to report that income either way. Okay. So I'm going to give you a minute to read this. This is a list of real people I've talked to who aren't sure whether they're in business or not. In a minute, I'm going to be quiet and let you read these and jot down which ones of these you think are in business. Which ones are business owners? Okay, we have another good question in the chat that I won't forget. But does anybody want to put in the chat the answer? Which of these are not business owners? Maybe that's a lot to ask. You'd have to retype them. But I'll tell you, it's only the last two. Everybody except the last two is a business owner. Because the reason the second last one is not a business owner, because she gets a W-2 from everybody she works for. So she's an employee. Even if she works for a lot of different people, she's an employee. Later, we're going to talk about why is that such a big deal, whether you're an employee or not. It is a big deal. And this last one I already talked about a little bit, a hobbyist who enjoys making jewelry and thinks she might sell some someday, but she's really not trying to make money at it now. Those two people are not in business. The first one because she's an employee, the second one because she has a hobby. Those things are not business. Everybody else is in business. For example, this part-time actor who set up an LLC, part-time actor who didn't set up an LLC, that's irrelevant. The LLC protects you from liability, doesn't change your tax situation, doesn't change your status as a business owner, and it's not necessary, okay? The gig worker who gets a 1099 but hasn't yet applied for an employer ID number or business license, those are kind of different issues. She probably should do those things, but they don't change her tax status. They don't change the fact that she's a business owner. Pet store owner with a shop and $6 million in annual sales. If that person is the owner, doesn't matter that she earns a huge amount of money and that some of these other people probably earn small amounts of money, same tax status, business owner. Okay. So I mentioned an LLC briefly. An LLC is one way of setting up your business. It is not necessary. These are the basic business structures that are available to us people who own a business, whether we're one person or whether we're a big corporation with a lot of employees. These are the options. We can be a sole proprietor. That's what happens automatically. The first day you drive for Lyft, the first day you sell your basket weavings and you're serious about being a business owner, you are a sole proprietor. That happens automatically. You don't need to file any paperwork. You're just a sole proprietor. And for many people, by the way, that is totally fine. You don't have to do these other things. The second item here, LLC, very common in California. And by the way, LLCs are managed at the state level. So California law is what matters for us. You can be a single member LLC, you can be a multiple member LLC. Many people who start a small business on their own, they set up a single member LLC. It's still just you. So why would you be an LLC rather than a sole proprietor? Some people think, oh, if I start an LLC, all my expenses will be tax deductible. Oh, it'll be good for me financially. No. Okay. The reason to start an LLC, it stands for Limited Liability Company. So the explanation for why you would do it is right there in the name. It limits your liability. That can be very important for some types of business. So if you are in a business where you think you might get sued, you may want to open an LLC because you may want to limit your liability. And what that does is that separates, that says, okay, my company and my personal assets are separate. And if you're going to sue me because of something I did in my business, I want to protect my personal assets. But it doesn't change your tax situation. It's what we call a see-through structure. So when you fill out your taxes, whether you have an LLC or not, all the income of the business is your income. It doesn't change that at all. Also, people say, oh, I think I'll save money if I set up an LLC. That's absolutely false. LLCs cost money. The minimum fee for an LLC is $800 a year in California. That's the minimum. If you earn money, it starts going up to about $11,000 a year, something like that. Now, again, if you need to protect yourself from liability, you should do it. And you might want to see a lawyer to talk about that, to find out for sure if you should do it. From a tax standpoint and a financial standpoint, LLCs cost money. They don't save money. Next structure is, and we've got more information about each of these, partnerships. That's usually a good idea if you are two or more people in business together. You may want to form a partnership. It makes things more legal, more clear, etc. Partnership is also a see-through entity. So let's say, for example, your partnership owns $1 million a year, but there's two of you, you set up a partnership, the net income of the business is $1 million a year. Because it's a see-through entity, you don't get to say, oh, that's business income, my salary is only $6,000 a year. No, if you own a partnership and you and your partner own it equally, your taxable income that year is $500,000, your partner's taxable income is $500,000. The business is not really separate from you. The money flows through right to your personal taxes. Then we have S corporations. Many people in business like you want to be S corporations. S corporations are complicated, but there are some tax advantages to that. Two things about an S corporation. They are a bit complicated. If you have an S corp, you can't do your own taxes. You must hire someone who understands how to do S corporation taxes, because now your business has to do its own tax return. And then you have to get a copy of that and use that business tax return to help you fill out your personal tax return. Another important thing about an S corp is it must pay wages and must pay a reasonable amount of salary to you as the worker. So an S corp is more complicated. It does have tax advantages, but you're going to need help if you do that. You're going to need a payroll company to make sure you're doing taxes. The final one I have on here is C corporations. That's the entity you usually think of when you think of a big company. Apple is a C corporation. Google is a C corporation. C corps are big companies. Probably you are not a C corp, and probably you don't want to be a C corp. I'll get into some reasons later why. But the first four options, the sole proprietorship, the LLC, the partnership, and the S corp, those are all common ways to organize a small business. So more information about each of them. The default, you're a sole proprietor as soon as you start working or earning money. You and the business are one thing. You can have a business name, but basically you call it a DBA. So you may be, Sarah's Real Estate Company. That's fine. And you put that on your Schedule C on your tax return, Sarah's Real Estate Company, even though your name is Sarah Smith, but all the money flows through, all the money belongs to you. You fill out a tax form called Schedule C. C is for small businesses. You pay zero licensing fees. You do not have liability protection. So this is the reason that many people form an LLC rather than a sole proprietorship. Maybe it's not important. Maybe you're making baskets or writing a memoir. Well, I guess someone could sue you over a memoir. But liability protection is not necessarily vital for everyone. Also, there might possibly be other ways to manage it. If you have good malpractice insurance, maybe you don't need liability protection. Something, or E&O insurance, that stands for, what does that stand for? Errors and omissions. If you have good insurance, it might make up for forming an LLC. Now, on the positive side, when you're a sole proprietor, all your business expenses are deductible. That's really good to know, right? You do not need to form another business entity to deduct your business expenses. And I dwell on this because this is a very common misunderstanding. People come to me all the time and say, oh, we have this business idea. Should we form an LLC so we can deduct our expenses? Nope. You should just start the business, act serious, make some money, and then we can deduct all your business expenses. The LLC is not part of that decision. Okay? Even a lot of people come to me, I'm sorry to say, and say, what if we pretend we have a business? What if we form an LLC? Like, is our car tax deductible? No. You're not supposed to pretend anything. And no, your mileage is the miles that you drive your car for business is tax deductible if you legitimately use your car for business and if you keep good records of the business use of your car. I smiled a little because this is a big deal in real estate circles, right? You may very well use your car a lot. If you're a real estate salesperson, you're probably driving clients around in your car. Keep track of your mileage. That is tax deductible if it is helping you to earn a living. Okay, so back to more about that later. The key point is you're a sole proprietor. As soon as you're in business, you get to deduct all your business expenses and you qualify for the qualified business income deduction. Qualified business income deduction can be very complicated, but the simple answer to what is that is it's a 20% reduction of taxable income for small business people. So that 20% reduction, that's quite valuable. Started in 2018, and it does apply to sole proprietors. You do not need a fancy structure, or you do not need a lawyer to get the QBI deduction. Next is the partnership. It's a pass-through. The partnership does not pay taxes. The partnership is not a separate legal entity for tax purposes. You do need to fill out a Form 1065 for your partnership. You probably want a tax pro to do that for you. Partnership may or may not provide you with liability protection, but all your business expenses are deductible and your qualified business income, you're qualified. Peeking again at questions. Okay, so that's how partnerships work. Now, it can't be a partnership by yourself. You have to have a partner. That may be obvious. Okay, then we get to the LLC. This is a pass-through entity. The LLC does not pay taxes. It's not a separate entity that has to pay its own taxes, the way a big corporation does have to pay its own taxes. The IRS treats a single member LLC like a sole proprietorship, and it treats a multi-owner LLC like a partnership unless you request to be treated as an S Corp. You will pay state level taxes and fees. You have to fill out tax form 1065 if you're a partnership, and you have to fill out K1 for each partner. But notice these things, these last two have been consistent so far. All these forms of small businesses get to deduct all their business expenses, and they get the qualified business income deduction. Those are the same for all of these. S Corp gives you limited liability. That's important. It's a pass-through in the sense that the S Corp itself does not pay taxes. You do have to fill out more tax forms. An S Corp is a little more complicated. You do get state qualified business income deduction, and all your business expenses are deductible. So again, note that I highlighted in purple, every entity we've talked about so far, including the sole proprietor, gets to deduct all their business expenses. As long as they have an actual business and they're deducting legitimate things, all their business expenses are deductible. All right. Then we come to the C corporation. This is not for small businesses. This is for big businesses. The C corp gives you liability protection, but it gives you double taxation because the corporation pays taxes and then the money that's distributed to you as an employee or a shareholder is taxed again. It's expensive. You got to have additional fees and lawyers. Of course, you get to deduct all your business expenses, but you do not qualify for the qualified business income deduction. All right. So in summary, the sole proprietorship is the simplest and least expensive. The partnership you want to do if you have a partner. The S Corp or the LLC you want to do if limited liability is important to you. Other taxes and fees. I looked up some things for other places just to see, but basically in California, for most of us, this is what matters. Your fees every year for your LLC is at least $800 a year. Also, you have to file a form every year. And your LLC fees may be up to as much as almost $12,000 if you have a high income from your business. But for many people, it's $800 a year. It's not free. Let's see, Orange County, I suggest you check if that's where you are, that you check your local rules. You go to ocgov.com. If you are in the city of Orange, California, need a business license because you're operating in the city. Los Angeles, we won't dwell on now. So your business structure, always talk to your own tax professional, attorney, or financial advisor. Everyone's situation is different. And of course, there are some complications and complexities. But remember, everybody with a legitimate business gets to deduct legitimate business expenses. You don't need a special structure to do that. But notice I do stress the word legitimate. You are probably in a legitimate business, but people do ask, people see some ridiculous things on YouTube. I would plead with you, do not get your tax advice from YouTube. People ask me the craziest questions. And often they think, again, that, oh, all I have to do is form an LLC. I actually had 3 people in 1 week call me last October. There must have been something on YouTube in October. They called and said, if we buy a new car, but we set up an LLC, is that car free? Or can we deduct the whole car? No. Use a little common sense. No. Just because you set up an LLC does not make you a business person. And your car is not tax deductible or free just because you say you have a business. Your mileage is deductible if you have a legitimate business, you drive that car in your business, and you keep track of your mileage. And again, for realtors, that can be a very valuable deduction. Number one, because you probably do drive a lot in your business. Now, you must be organized. You must keep track of that mileage. But number two, because you are a real estate professional, I think most of you probably are real estate professionals, we understand, we the people and the IRS, people understand that a real estate professional probably needs a nice car, right? You need a better car than I need. I rarely use my car for business. I may have to drive to drop off some clients' tax forms, but I do not need to impress clients by having a nice, comfortable car to drive them from appointment to appointment. You probably do. So if you're using your car for business, yeah, you get to deduct that business mileage, but you can't just buy a car and pretend you're in business. That's ridiculous. Okay. So all legitimate business expenses are deductible regardless of your business structure. Next little topic, employer identification number. This is kind of like a social security number, but for a business. You can have one with any of these types of business structures. Do you need one? If you're a sole proprietor, not necessarily, but you need an EIN if you hire employees. If you want to set up a solo 401k plan, which I strongly recommend for people who have a sole proprietorship, and if you want to protect your identity and privacy. So first of all, some good news, they're free and they're easy to get. If you want an employer identification number, you go to irs.gov, businesses, small business, yada, yada. You don't have to memorize this link. You can kind of just Google it. You go to the IRS and you get an employer identification number. Now, I got one a few years ago, partly because I wanted to set up a solo 401k plan, but also it's nice, it can protect your privacy. So for example, I do a lot of freelance work for various organizations. They send me a 1099 at the end of the year. Before I had an employer ID number, I had to put my social security number on everything. As you know, it's kind of risky. You don't want everybody knowing your social security number. It's important to kind of protect that and keep it safe. So now that I have an employer identification number for my business, I can put that on official forms instead. protects my social security number a little bit. So if you're in business, and again, it doesn't take much to be in business, right? You start your new realty business, it's fine. Go to the IRS, apply for an employer identification number, and that's good. Someone says, how is this different from a tax ID number? I think we're probably talking about the same thing. A tax ID number, I think a tax ID is a more generic term that may include a social security number or an employer identification number. But if you have a tax ID number, you're probably talking about this. You probably know the structure of a social security number, right? It's 3 digits, 2 digits, 4 digits. An EIN or a tax ID is 2 digits and then I think 7. It's 2 dash and then 7 digits. And I think the first 2 are usually 86. So if your tax ID number is 86 dash something, you probably have one. Somebody says, if you get paid through an EIN, do you need to file 2 tax forms? No, you do not, which is great. An EIN is quite simple. So if you are, let's say you're a sole proprietor, you have an EIN, you fill out your Schedule C with your business income and business expenses. It's part of your ordinary personal tax return. And on that Schedule C form, you type in your EIN. But it is not a big deal. I love things that are not a big deal. Go ahead, if you're in business at all, go ahead and get an EIN. Again, it's free, does not require more tax forms. You just type it under your Schedule C. So it's usually a good idea. Okay, what tax forms do business owners file? If you are a partnership or a multi-member LLC, you have to file a 1065. If you're an S Corp, you have to file a 1065-S. Personally, although I've mentioned I'm a tax pro, I don't do either of these types. You need to hire a person who's good at these, who knows how to do them. Okay, they're a little bit specialized. There are lots of people who are good at it, but just be aware it's a little bit specialized. If you have a person who's been doing your personal taxes for years, and then you say, oh, I formed an S Corp, I need a new tax form, they may or may not be willing and able to do it. Also, if you do your own taxes on TurboTax, not sure you can do the 1065. So you may need to hire someone if you form an S Corp. And then with either of those types, then those include a K1. That's the part that goes to the individual tax person, tax entity, which is you. So for example, if you have an S Corp, your S Corp is an entity, it files a tax return. The S Corp then issues you personally a K1. You use that K1 information for your own tax return. All right, which tax forms to file on your personal 1040? This is getting into some real estate meat right now. Just checking questions again. Okay, so Schedule C is for small businesses. Schedule E is for real estate holdings. Now, for you, that might be a gray area. Am I in business or am I holding real estate? Probably maybe both. Okay, so Schedule C is a profit or loss from a business. That's what I fill out. As a self-employed financial planner, I fill out Schedule C. My client who's writing a memoir is a self-employed writer. She fills out Schedule C. My client who drives for Lyft files Schedule C. Schedule E is for supplemental income and loss from rental real estate. Now, I fill out a Schedule E because I own one little condo. It's in another state. It's a 1-bedroom condo. It's very small. I earn a little bit of money from it each year. I fill out a Schedule E for that. For me, Schedule E is not my business. My business is financial planning. My real estate holding is a small investment on the side. That is true for many Americans. Many people own a little real estate on the side. It's not their day job. We fill out Schedule E. What is special about real estate professionals is they may be able to put all of their real estate income on Schedule C because it's their business, as opposed to Schedule E, where it's an investment. This has many ramifications that we will get to. So we're moving on now to real estate professionals. May very well be you. Now, there are real estate professional, or REP. It's a term of art for the IRS. The reason I mention that is in casual conversation, you may say to somebody, yeah, I'm a real estate professional. I might even say that if I wasn't thinking, like, oh yeah, I own a condo. I'm a real estate professional. I'm not a real estate professional, okay? Under IRS law, there are very specific things that make you qualified to be a real estate professional. I'm going to peek at another question here. Someone says, Oh, let's see. First of all, someone says it should be an 1120S for the S Corp. Oh, thank you for that. 1120S. I'll check my notes later and make sure I don't have an error in what I wrote there. And then someone says, I can help with S Corps if needed. They are indeed specialized. Okay, now the trouble is, do we know who that person is? That person's initials are ST. So ST, if you want to put your name in here, I'll say it out loud later so that people will know they can contact you if they need help with an S Corp. Meanwhile, someone else says, I have an LLC and an S Corp for consulting business, but no income for years from either. Can I put those on hold or can I dissolve it? $800 a year for each is pricey. If it were me, now the future is what matters. If you think you're about to make money in those business, I keep them open. I don't think there's any such thing as putting them on hold. So if it were me and I was tired of paying $1,600 a year to keep 2 LLCs open that I wasn't even using, yes, I would dissolve them. And that's a process. You need to fill out a form, go to the it's ftb.ca.gov. That stands for Franchise Tax Board.ca for California.gov. That's our California state website. And you can get information there about how to shut down your you have to fill out forms to shut down your LLC so you can stop paying those fees. Okay. Someone else says, I'm a real estate professional. Good. I have 2 rental properties plus real estate income from sales, and my tax person did both an E and a C. Should I combine them? Okay. That person has a tax professional. I like that. That's important. So I would trust their judgment. Chances are your tax professional knows your situation and did that for a reason. And I don't want to try to second guess them without more information. But again, it's good. It sounds like your situation is a little complex. It's good you have a tax pro. They probably have their reasons. Okay. So moving on to what is a real estate professional? I notice I abbreviated it. We know it's an official term because it has an acronym. So it's an IRS term of art. You might work in real estate without officially qualifying as a real estate professional for tax purposes. So what does it mean? And we'll get back to these. So the advantages to being a real estate professional. You would fill out Schedule C, usually if you're a real estate professional, Schedule E, if you're more of just a passive investor like me and like many Americans. One of the big differences is Schedule C is considered active income, that you're earning it. Schedule E is considered passive income, like an investment. They have different rules. And the reason I hesitate is they have different rules, but rather than try to expand on active versus passive right now, I'm pretty sure I have a slide for that soon. So meanwhile, the qualified business income deduction that I mentioned before, that's that 20% deduction in your self-employment income that you get to take if you're in business. I get to take a 20% discount on most of my Schedule C income from my day job, my business as a financial planner. I do not get a 20% deduction on my Schedule C income from my condo rental because I am not a real estate professional. QBI is for active income that you're earning in your profession, not for passive income that you're earning through just rental property income. Okay, so who gets to be one? First of all, you don't have to be a realtor to be a real estate professional. A real estate professional might be somebody who develops real estate, constructs it, acquires it, converts it, rents it, operates it, or brokers it. These are all considered real estate professionals, possibly. Material, okay, there's these 2 terms that I need to have slides for because I can't keep them in my head. There is active participation and there's material participation. So if you're a completely passive investor in real estate, you fill out Schedule E. If you actively participate in a passive real estate investment, you fill out Schedule E. This one is me, by the way. I actively participate in that I choose my property manager. I make decisions about who gets to rent my little property, etc. I have to pass certain tests to be an active participant in a passive real estate investment. So I get to fill out Schedule E. You, though, if you're a real estate professional and real estate is your trade or business, notice I capitalized trade or business, also IRS terms. They often say T or B. Then you do material participation, and then you get to fill out Schedule C, which has better advantages tax-wise. So you may be a Schedule C real estate professional. I am a passive investor doing Schedule E. All right. So to be in a real property trade or business, now we get to, well, how do I get to be one of these people? You must meet both of these requirements to be in a real property trade or business. More than half of the personal services you provide have to be in real property trade or business where you materially participate. So more than half of your personal services. So here's a real life example. I work with a young woman. She works for Salesforce by day. She's a graphic designer, I think. She makes a very big salary working for Salesforce, full-time job, so at least 40 hours a week. She bought 2 rental properties on the side. They're fairly complicated. She does a lot of work on them. She has to travel to visit one of them. One of them is multi-unit. She considers herself a real estate professional. The IRS did not consider her that. She tried it and they rejected her. The reason is more than half of her time, more than half of her personal services, meaning the work that she personally does, goes to her day job for Salesforce. So she is not a real estate professional. Now, if she retired or quit that job and continued doing all the work that she's doing on her rental properties, she'd probably be a real estate professional. But the IRS has somewhat consistently rejected people who have a day job. Now, I mentioned her employer, I mentioned that she earns a lot of money. That's actually not that relevant. Even if you have a day job where maybe you earn $40,000 a year, but it's a full-time job, you're expected to be there for 40 hours a week, 2,000 hours a year. It's a full-time job. I don't care if you only get paid a relatively small amount. More than half of your personal services are assumed to be in that day job. So that's a test of material participation. The other test is you must perform more than 750 hours per year in your real estate business. So you do need to keep track of your hours. There's a lot of good news for real estate professionals and for self-employed people. There are good tax advantages to both of those categories, self-employed and real estate professional. But the news I need to deliver to you is you must be a good record keeper. Okay, you do have to keep track of these hours and you have to keep them in some written form. Now, there's no determined way what that written form has to be. In olden times, a lot of people kept a notebook in their glove compartment. That's fine. If you have a pad of paper in your glove compartment and you write it down, but write it down every day. You know, today is what, February 5th. On February 5th, I spent 3 hours doing training for my real estate job. Keep track of it. Or, or, you know, today I drove to my rental property in Marin County. I spent X hours working on that property, and keep a separate log, my mileage. You know, I drove, for you, it's probably 1,000 miles to Marin County. For me, it's maybe 20 or 30. But you write down that mileage. You need a mileage log and you need an hours log if you're trying to do this. Now, I mentioned a pad of paper in your glove compartment. That's legal. Another thing that's legal is maybe you have a spreadsheet, an Excel spreadsheet on your computer at home. You come home same day, write it down in the spreadsheet. Fine. Maybe you have an app. There are many apps to help people keep track of their mileage and their hours and other things. Those are all legitimate ways, but you must keep track. Don't try to make it up at the end of the year. That's not, it's not legal. And it's also very difficult to fake it. You're not going to remember how many miles you drove or how many hours you spent working on your property. So keep concurrent records. But I talked a lot while leaving this slide up because this slide is important. Okay, you must meet both of these requirements to be a real estate professional. More than half of the work that you do has to be on real estate projects, and you must spend more than 750 hours in that business. Now, to put that in a little context, sort of normal full-time job is considered to be 2,000 hours. 2,000 hours is 40 hours a week, 50 weeks a year, assuming 2 weeks of vacation. That might not be your schedule, but just as a shorthand to help you think about it, 2,000 hours is a normal full-time job. So spending more than 750 hours means like at least a half-time job or roughly a half-time job. So you must meet both of these requirements. All right, more details. Beginning in 1994, I think that's when they invented this term real estate professional. You may be able to deduct all your current real estate rental losses regardless of how high your adjusted gross income is. And to deduct losses without limit, you must spend more than half your time in that business and work more than 750 hours a year and materially participate in each separate rental real estate activity. This is a restatement kind of what I had on my previous slide. This first item is super important. This gets to why do you care if you're a real estate professional? You may be able to deduct all your current losses regardless of how high your adjusted gross income is. So for context, someone like me, the little people who are not real estate professionals, if I have a loss on my property, I get to keep track of that. And by the way, many people do show losses on rental real estate. You probably understand this better than most people. But when you own a property, you start depreciating it. And depreciation is not money you put out in cash every year. You don't write a check to somebody, but it counts as a deductible expense. We get to deduct our residential real estate value over 27 and a half years. So if I buy a $1 million building, I'm going to do some quick math here. I buy a $1 million building, I divide that by 27 and a half years, I get to deduct about $36,000 a year in depreciation expense, even though I'm not writing a check every year for $36,000. What that means is you may very well show taxable losses, tax losses, even though you're successful, right? So that's nice. That's useful for tax purposes. But passive real estate investors like me do not get to deduct those losses if our adjusted gross income is more than 100 and I think it's more than 150,000. I think we can deduct part of it if we're between 100 and 150. But again, in California, $150,000 is not a high income. That threshold has not been indexed for inflation. So originally, only high income people were prevented from deducting their losses. Now, most real estate investors who are not real estate professionals cannot deduct their losses. If you're a real estate professional, you get to take a tax deduction for your real estate losses. Very valuable. Okay, tax losses, we don't want losses in real life, but tax losses help reduce your tax burden. So this is one of the reasons it's great to be a real estate professional. Now, in addition to being a real estate professional, you must also prove material participation. Notice that it allows you to overcome the presumption that all your rental activities are passive. So you must materially participate. All right, what does that mean? Now, this is a long list. I won't read them all to you, but note that this list from the IRS of what proves material participation, you only need one of those. Okay, you needed both of the above. You needed both of these. More than half your personal services has to be in real estate, and you must do more than 750 hours. But now, to prove material participation, you have to do one of these. So one of these, you participate more than 500 hours a year. We kind of know that because you already passed just 750 hours. So that might not be that hard. Then I highlighted a few I thought were interesting. If your aggregate participation in all participation activities exceeds 500 hours. So maybe I own 10 rental properties. I spend 51 hours on each of them. That's okay. I don't have to spend 500 hours working on one property if I own a bunch of properties. Also, I need to have materially participated in any 5 of the last 10 tax years. So you don't have to meet the standard every year. What else is interesting? You constitute substantially all your participation in such activities, okay, yada, yada. So there are 2 basic types of participation. There's material participation and there's active participation. Again, active participation is what I do. It's fairly minor. Active participation applies only to rental real estate. So it's not a term, if I were a broker or a developer, this is not a thing. This is just for people who have rentals. It's less stringent than material participation. I have to make some management decisions. If I do, I can generally deduct up to $25,000 in losses, subject to $150,000 limit on my adjusted gross income. So there are some limitations there. Material participation means that if you work on a regular, continuous, and substantial basis, your losses are not passive and you can deduct them in full. So back to kind of an overview. Why do we care if you're a real estate professional? Real estate professional uses Schedule C instead of Schedule E. It's a business instead of a passive investment. You can net your losses against active income. Very valuable. Let's say you're a real estate professional, but you have a husband who has a regular job. Maybe your husband or your wife earns a large salary from their job, so your family has a high tax burden. The losses from your business, if you're a real estate professional, your business losses count against that high family income. That's super helpful. Mine do not. Even if I had a spouse who earned a lot of money, the maximum I could write off would be $25,000. And I probably couldn't, because if I had a spouse, we would almost certainly together make more than $150,000. So netting losses against active income is very useful, and being eligible for the qualified business income deduction is very useful. So I already harped on this, but I'm going to say it again. Keep records. Jot down the hours you spend. Keep your toll receipts and other records that proved you visited your properties. So this is a little bit of a different issue, the second one, from keeping track of your mileage. You do need written confirmation of your mileage to prove that you have a right to deduct your business mileage. But if you were ever questioned, if you ever said, I'm a real estate professional, I spent more than 750 hours working on my properties this year, suppose you were audited, how would you demonstrate that? One way you would demonstrate it is maybe every time you drive to Marin County, or for Southern California, I should have a more realistic example. Maybe you own a rental property in Joshua Tree. Every time you drive to Joshua Tree or Palm Springs, keep track of your toll receipts. It will at least help demonstrate to the IRS agent, yes, I drove to Palm Springs once a week to work on my rental property. Once a week, here's the toll receipt to prove what time I went over, what time I came back. So at least I can demonstrate, yes, I put in some hours going to that property. You want to keep any records you can that you visited the properties. And I say don't have a day job. Maybe you need to have a day job. And if you do, you do. But just keep in mind that if you have a full-time job, it will make it unlikely that you get to prove you're a real estate professional if you have a day job that is not in the real estate industry. There's one real example. This is from a discussion board I'm on for tax professionals. So someone noticed the person signed herself feeling worried. She wrote, I have a question on real estate loss. This is scaring me, so I'd appreciate some input. And then she says, I have a planning client who does his and his wife taxes. They file as married filing jointly. Their combined income is about $157,000. They own 3 rental properties, and they're claiming a loss on all of them. Reporting a loss of $89,000 on their tax return, forcing their adjusted gross income down to $33,000. Can you do that? Now, first of all, I would just say, if I were an IRS computer, no one knows exactly how the computers work at the IRS. They don't want us to know. But this already feels like the sort of thing that might be a little suspicious, that might cause a computer to bump something out and suggest to a person, hey, take a look at this. This is a family with a reasonably high income, $157,000, but somehow their adjusted gross income is only $33,000. This might raise an eyebrow, right? What's going on here? And then this person says, can you do that? I thought you couldn't deduct passive income from wages. I thought there was a $25,000 deduction that phases out when your income is over $100,000. Yeah, we just learned about that. So she's concerned, can they do that? And the real life answer is that the IRS presumption is if you are a full-time W-2 taxpayer, they presume, they don't prove, but there is a presumption that you will not meet the hours test to qualify for real estate professional status. And then this other advisor who commented said, I would expect an audit in about 9 to 12 months. And the first thing the IRS will request is your time log. Okay, so this is another tax professional who's just offering an answer here. And the answer is expect trouble. The fact that these people are claiming to be real estate professionals while they have a day job, it's going to raise questions. And she said the first thing they're going to ask for is your time log. That's that record keeping we just talked about. Keep track of how much time you spend working on your real estate properties. This is from an article at Forbes magazine, Forbes.com, which I trust. They're usually a good source. They say the tax court is more or less saying that people with day jobs will never be able to meet the standard for real estate professionals. Okay, someone just put a question in chat that says, can realtors contribute to an IRA if they are over the age of 70 and have some income from their real estate compensation? Okay, the answer is probably yes, okay? I think there used to be an age limit on contributions to IRAs. That's gone. The only important thing is that you have earned income enough to cover that. So if your net earned income from any type of profession, including real estate, if it's more than $7,000, you can put $7,000 in your IRA. If you're, let's see, if you're 70, you can probably put 8,600. But again, the only requirement is you have to have earned income to cover it. Age is no longer a barrier to that. But you bring up a good point that's relevant here. Let's see if I have it here. If my only income was from that rental property and I'm not a real estate professional, I could not make an IRA contribution. You can only make IRA or other retirement contributions. You can only make those contributions from earned income. My income from my day job is considered earned income, and from my business, earned income. My income as a small-time real estate investor, my income from that is not called earned income. That's another term of art from the IRS. Earned income. Even if I say, man, I earned it. The last tenants were horrible. I had to go through the process to eject them, yada, yada. Even though I feel like I earned it, it's not technically earned income. Okay, so that means that I cannot make retirement plan contributions out of my rental income money. If you're a real estate professional, you can. Okay. All right. I promised that I would show you a little more of real tax forms. I'm going to peek in your questions one more time. I think there was one question I didn't get to yet. If there is a question I didn't get to, let's see. Oh, wait, here's one, might be relevant. If I sell my own rental property as a real estate professional, can I contribute to my IRA to reduce my capital gains? Okay, sorry to have to get a little bit technical here. If you are a real estate professional, you can contribute to an IRA, but you cannot contribute to an IRA out of capital gains, okay? Capital gains are considered investment income. And investment income, again, is different from earned income. Now, if this person who's asking the question, she says, you mentioned needing income or contributing, I'm self-employed. Yeah, if this person who's asking the question also has earned income as a real estate professional. And for example, let's see, she's selling her own property, so probably there's not a commission. But if you earned a commission from selling a rental property, that's earned income. You can definitely contribute to a retirement fund from that. But capital gains are not considered earned income. I hope that answers it. It does get complicated. All right, I'm going to check if any, and by the way, that person, I would definitely hire a tax professional to work on your tax return. That capital gain you got from selling your property, there could be some nuances to that. So I hope that you have a tax pro that you can talk about your specific situation with. I used TurboTax myself for years before I started doing taxes professionally. It can be helpful. And of course, there are other tax programs as well that I don't know as well. They can be good. But if it's anything complicated, tax laws really are complicated. And you may want to talk to a live person in addition to doing your own taxes. All right, I want to show you some actual tax forms. This is a Schedule C for profit or loss from business. You'll notice line A, I hope this is big enough for you to see. Line A, you say, what is your principal business or profession? You would write real estate professional. Then here, excuse me, line C, it says business name. If your business has a name, you type it in here. If it doesn't, totally fine. If your business doesn't have, it's basically just you, totally fine. If your business is Sarah Smith Real Estate, you do not need to have a business name. Okay, if you have an employer identification number, notice here, line D, you put that here. Same tax return, your social security number is going to appear at the top of your whole tax return, but you put your employer ID number for your business here. Excuse me. Then we have a line for business address. for many, probably most self-employed people, your business address is your home address. No problem. Excuse me. You can just check a box for that. Most people who are self-employed are on a cash basis. What that means is you don't worry about receivables and payables. Just whatever money you whatever money you received this year is taxable this year. Whatever expenses you paid this year count this year. That's the relatively simple way to do it. Okay, then we see this fun part to make it a little bigger. Expenses. Excuse me. Sorry about that. Sometimes when I talk too much, I start to cough. So here's where you enter your business expenses. You'll notice this is the list. Now there is a line item here, 27A, that says other expenses. So there is a place later on this form where you can list things that don't appear here. But as much as possible, it's good to try to squeeze your business expenses into these categories. If you have a tax professional, excuse me, they're going to need to squeeze you mostly into these categories. They may be willing, they will be willing to list a few things separately on the other line. Like you'll notice there's no line item here for internet use. You probably need to use the internet in your business. So some portion of your cable bill, if you work at home, some portion of that bill is tax deductible as a business expense. Doesn't appear as a line item here. It's fine to put that under other. But as much as possible, see if you can organize your business expenses into these categories. And the reason for that is that your tax pro has to squeeze them into these categories. So you can save some time and trouble if you think of these categories. For example, insurance other than health insurance. If you pay errors and omissions insurance, if you pay malpractice insurance, if you pay insurance on the building where you do your business, you want to put that here. Legal and professional services. I don't think there's a line item for continuing education, which is important for most of us. I'd list that under other. But it's good to know that these are the categories that the IRS puts in here. If I worked for the IRS, I'd say it's time to do an update. And I'd put some more updated things on this list. Whatever. Like there's a utilities line item, but there's no cell phone line item. So you may want to figure out what portion of my cell phone bill should I apply to my business. And by the way, any reasonable estimate is fine. You do not have to keep track of every single call that you make for business and try to make that, charge by the call. You can just say, you know what? I pay $100 a month for my cell phone. I use it roughly half for business and half for personal. I'm going to put 50% of my cell phone bill here under utilities. That's legitimate, as long as it's reasonable. If I say it's 90% business and I don't do any business, that's not reasonable. 50-50 is probably reasonable, or whatever you think makes sense. It's okay to estimate that kind of thing. Okay, so other things on Schedule C, we'll notice expenses for business use of your home. That's a complex issue that we'll get to in a little while. I want to point out one box on here because I see people make this mistake. Do you see this little box that says all investment is at risk? If you're filling out Schedule C, check that box. Okay. And if I realize most people don't do your taxes on paper anymore, but your forms will be produced on paper. So if you do it on a software program, proofread before you send it in and look at this. Make sure that box is checked. And if you're working through TurboTax, it will ask you a question. You may say, I don't even know what that means. Check the box for all investment is at risk. The reason is if you do not check that box and you show losses in your business, in any business, they're not tax deductible unless you check that box. Sort of a weird little thing. Just check the box. Everything's at risk. Okay. Now I'm going to show you Schedule E. Notice that this says supplemental income and loss for rental real estate, royalties, partnerships, yada, yada. Okay. So people like me who are little real estate investors, we fill out Schedule E. But I highlighted this line on Schedule E that says, note, if you are in the business of renting personal property, use Schedule C. And so that's different. So then we fill out rents received from various properties, etc., and all the expenses related to that. Sorry, I'm trying to make this small again. And do that. Oh, make it weird. Okay, so that's Schedule E. All right. Now, Schedule C versus Schedule E. Why does it matter? Schedule C, if you're in business, you're going Your income is considered earned income, so you can take a retirement plan deduction. You do pay self-employment tax. Not everybody loves that. Self-employment tax is Social Security and Medicare, also known as FICA. We pay that on earned income. We do not pay that on passive real estate income. If you're in business, you get to take the qualified business income deduction. You're considered self-employed. So if you're self-employed, you can deduct what you pay for health insurance. You can deduct net losses from your total taxable income. And if you meet the qualifications for home office deduction, you can take that. If you are a Schedule E passive income investor, you cannot make retirement plan contributions. It's not considered earned income. You don't get the QBI deduction. Because rental real estate income is considered investment income, you may be subject to the net investment income tax. The net investment income tax is an extra 3.8% tax on investment income if you're single and your adjusted gross income is more than 200,000, or if you're married filing jointly and your adjusted gross income is more than 250,000. You may not want to memorize all those numbers right now. Just be aware that passive real estate income is considered investment income. Unused losses are suspended, and you can take them in the year you sell the property. So you don't really lose those losses, but you don't get to take them along the way. All right, next big topic. I've mentioned a number of times QBI, or qualified business income deduction. Before we get into that, I'm picking at your questions again. Someone says Sarah is on a Pro Otter plan. Sorry, I'm not sure what that means. That may not be for me. But you're still here, right? Yes, I see you're still here. Something about, might be something about our Zoom connection. So I'll leave that in Elsie's hands. Okay, what is the qualified business income tax deduction? In effect, from 2018 forward, it was supposed to expire end of 2025, but it's recently been extended. So it is, most simply, it's a 20% tax deduction on net earnings from pass-through businesses. That includes the sole proprietorship, the partnership, the S Corp, and the LLC. Those are all pass-through businesses. It applies to all of those. This is a little bit weird. It also applies to income you get from real estate investment trusts and publicly traded partnerships. Those are not things you're actively managing. I just mentioned it because if you get a statement from Vanguard or Fidelity or somebody at the end of the year, it may show a line item with a little bit of QBI deduction for investments that you made. For some reason, it applies to a few things like that. It does not apply to C corporations. It does not apply to passive real estate income that appears on Schedule. There are complexities, but essentially it's a 20% reduction. Okay, now we're going to get into business deduction, because again, we're talking to you as self-employed people. Just one thing that somebody wrote in the chat, Roth are not deductible, right? A little bit of a detour, but it is important. Yeah, there are two basic types of retirement plan contributions. Pre-tax contributions, you get a deduction right now, which is great if you're in a high income tax bracket. Take the deduction right now. Or if it gets you under a certain threshold, so you can get other kinds of deductions because your income is lower, that can be super valuable. But if you make a pre-tax contribution, then later when you're old and you're pulling money out, you're going to pay full ordinary income tax on the amount that you pull out when you take it out. The other big category of retirement plans is Roths. When you make a Roth contribution, you do not get a tax deduction now, but grows tax-free for the rest of your life. So Roth contributions are especially good if you're young. There's a long time to grow. They're especially good if you're in a fairly low tax bracket right now. So the tax savings right now are not a big deal, but you expect to be in a higher bracket later. And also Roths are just great in general. It really is a very valuable thing. But yes, to this person, you are correct that you do not take a tax deduction in the current year when you make a Roth contribution. And by the way, I'm going to mention this at the end, but I'm going to come back and talk to all of you about all the details of retirement plans later this year. I have the exact date later in the slide, but do stay tuned. And I'm sure Elsie will let you know also. We're going to do a whole presentation that's just on every type of retirement plan. We'll get into all the nuances of Roth versus pre-tax, among other things. Okay, business deductions. So this is for people who own a small business. Business expenses are all still deductible. The reason I say still is a lot of people got confused in 2018. There's a massive change in tax laws in 2018. One of the effects of that law from 2018 through 2025 was that because the standard deduction was raised, most people no longer itemized personal expenses. A lot of people got confused and thought that meant their business expenses were no longer deductible because they were not itemized. That's not true. Your business expenses are always deductible. If they're legitimate business expenses and you're really in business, your business expenses are always deductible. Your business expenses usually go on Schedule C. Your rental real estate expenses go on Schedule E. Neither of those has anything to do with your personal deductions, which go on Schedule A. Schedule A is where that's what we talk about itemizing. That's where itemized deductions go. And so these are Schedule C deductible business expenses. This is just a piece of that document I already showed you, Schedule C. This is where you put anything else that wasn't in those categories. And what's deductible for business is anything that's ordinary and necessary. So ordinary and necessary depends on your business. In my business, it's not necessary to have a nice car. In your business, it's necessary probably to have a nice car, depending on what you do. So what's ordinary and necessary depends. Let's see, what else? If I were a clown, it would be ordinary and necessary for me to buy a clown suit. And it would be something that's definitely a business expense. Sometimes I have to put on a skirt and high heels to go see a client. Just dressing nice, dressing professionally, that is not deductible. It's not specific to your business, okay? But if you're a clown and you need a clown suit, or if you're a waitress and you need a waitress uniform, uniforms generally are deductible because they're necessary in that particular business. I see another question. More questions about retirement plans. I'm glad to see it because retirement plans are super important. And as I said, we're doing another whole presentation on retirement plans soon. But let me see if I can answer this one. What yearly maximum deduction, single 68 years old with Roth? Oh, I don't think I understand this question. This sounds kind of specific. You probably want to talk to your own tax pro about this. Maximum deduction. There's no maximum deduction for business expenses. It's just whatever you spend on your business. If you are, oh wait, maybe I understand. Maybe this is for a contribution to a retirement plan. If the person makes $7,600, which I see in here, if you make $7,600 and you put $7,600 into a pre-tax retirement account, then yes, you can deduct that. If you put $7,600 into a Roth, that is not deductible in the current year. Okay, I'm going to try to get away now from specific retirement plan questions because we have so much to do here. So anything ordinary and necessary. Now, when it comes to self-employed business people, again, all your expenses are deductible. If you buy supplies, that's deductible. If you need to take someone out for a business meal, that's 50% deductible. So these are the three categories that seem to raise the most questions: automobiles, home office, meals, and entertainment. Supplies are sort of obvious, right? If you need to buy a notebook for your business, that's deductible. If you need a new computer for your business, that's probably deductible. If it costs a fortune, if you're buying something that costs thousands and thousands of dollars, talk to your tax pro. You might need to depreciate it over time. But most expenses, I just bought a new computer case. I spent about $30 last night on Amazon. That's definitely a business expense. That's so I can take my laptop to different places. Those things are easy, right? You pay out money, it's a deductible business expense. These three categories are fairly confusing and complicated, so we're going to talk about them. So first, business use of automobile. If you use your car only for business purposes, you can deduct the entire cost of ownership and operation. That is very rare. Most of us do not have a car that we use only for business. An exception might be if you run a taco truck, right? Maybe you have a taco truck business, you never use that truck to pick up your kids from school. Then that's totally a business expense and you can probably deduct the entire cost of the truck. That's very rare. Most of us have one car or maybe two family cars. We use them for both business and personal. Totally fine. You do not need to buy a special car for your business. You can use one car or two or three family cars, but you can only deduct the part that you spend on business. There are two ways you can do the deductions for a car. You can use the standard mileage rate or the actual expense method. I strongly recommend the standard mileage rate. It's way easier and it's very lucrative, and you're less likely to run into complications. If you take the actual, you have to keep track of all these things, your gas, oil, repairs, tires, insurance. You have to keep track of everything. You have to depreciate the value of the car over time, and you have to use your car more than 50% for business. That's complicated. Mileage rates, not so complicated. All you need to do, keep that log. How many miles do you drive for business? It can be very detailed. Maybe like you had to drive to the stationery store to buy that notebook. That was a mile. Jot it down or put it in your app. I apologize for sucking on a cough drop. I am over a cold, but I don't want to cough in your faces. So anyway, that's why I'm making a little weird noise right now. All right. The mileage rates right now are quite generous. This is the highest it's ever been, I think. Business mileage, you get to deduct 72.5 cents per mile. That's pretty valuable. If you keep track of your miles and put that on your tax return, you will notice it reduces your taxes significantly. It's well worth doing. 2025, the year we just finished, business miles are 70 cents per mile. Also quite high historically. Also, if you use the mileage method, you do still get to deduct parking fees and tolls for business. So let's say you drive over a toll bridge every day, you spend $10 on tolls. I can deduct 72.5 cents per mile for driving over that bridge and also deduct the $10 in tolls. So always keep your receipts for those things, or whatever method you have. I no longer get a paper receipt when I drive over the Bay Bridge or the Golden Gate Bridge, but I get a monthly summary of all the tolls. That's fine. You know, they mail me one, I can keep it in my business records, and I can circle the bridge tolls for the days I was driving for a business purpose. Totally fine. That's a legitimate record. So, but keep a record, parking fees and tolls, and keep a record of your mileage. Publication 463 is the IRS publication that tells you all the rules. You can't change back and forth between the standard mileage rate and the whatever we call the other one. So I like just using the standard mileage rate. Okay, so that's it for cars, except for one other key thing I have to say. I may have a slide on it later, but when I do someone's taxes, I send them a tax organizer. You're probably used to this, where you answer a lot of questions. And I will say, how many miles did you drive for business? They need to write that down. And then I have a question that says, do you have written evidence of this? If they click no, I cannot take the deduction. You must have written evidence of your mileage, okay? Try not to scramble and try to make it up later. Try to keep it on a regular basis. Okay, next complicated issue. Someone says, if we buy a new car, what can we deduct? Okay, so again, if you buy a new car, you do have the option to do the more complicated method of figuring out the depreciation on the car. Hire a tax pro for that. Don't try to depreciate it on your own. And keeping track of every time you buy new tires or get the battery changed or whatever. I do not recommend that. I recommend you take the standard mileage rate of 72.5 cents per mile, which means it doesn't really matter if you buy a new car or if you use your old car. 72.5 cents per mile either way, okay? So at the moment that you buy that car, there's not a tax deduction at the moment you buy a car. There's a tax deduction when you use the car. And it doesn't matter if you're using a new car or an old car. Okay? So that's why when I said I got these 3 weird calls in October from people who said, oh, I heard if I buy a new car, I can deduct it. I think somebody was giving them some confusing advice online. You get to deduct your mileage regardless of how long you've owned the car. Okay, next complicated issue, the home office deduction. I hear a lot of people say, oh, I don't take the home office deduction because I hear it triggers audits. Those people are not wrong. The home office deduction can be a red flag to the IRS. More people get audited with home office deductions than without. However, it's a valuable deduction. If you qualify for it, you should use it. Just make sure you follow the rules. I have taken a home office deduction for decades, and the IRS has never asked me questions. And I think it's in part because it looks reasonable. And I do follow the rules. So, two basic rules. You must use part of your home regularly and exclusively for business, and it must be the principal place of your business. Now, if you are selling houses, you may say, well, I actually do more business in my car or out on the road. That's okay. That doesn't count as an office. But for the paperwork and the things that you do, those are only done in your home, right? Now, the regular and exclusive use is important. If you're lucky enough to have a separate building, like a shed or a garage that's just your office, that's pretty easy. But it can be a room in your house. It can even be part of a room. Okay, maybe you have a corner where you keep your desk. That's okay. Figure the square footage of that corner or that room, and that's what you get to deduct as a home office. But it must be regular and exclusive. Exclusive is important. So if I have a room that I say, oh, that's where I do all my writing, that's my home office, but I also sort the laundry in there and the kids also play in there, sorry, doesn't count because that's not exclusive use. Exclusive use means I use it only for my office. It means your spouse doesn't also use it for their office. Maybe they have a different office. It means you don't do the laundry in there. You don't watch TV in there. You don't serve dinner in there. It's just your office. That's exclusive. Okay. Many people fail on that. Many people do work at home, but they don't have a space set aside for it. If you can set aside a space, good idea. You know, maybe half a room. Maybe half a room is your office and you use only that. Then what you do is you calculate that square footage. If you're using TurboTask, it'll ask you questions. It'll say, what's the total square footage of your home? What's the square footage of your office? And then it'll do that math and say, oh, I see her office is 10% of her home. And then you get to deduct 10% of your mortgage or 10% of your rent and 10% of your homeowner's insurance, anything related to that, you get to deduct for the percentage that is your home office. Okay. Just more details on that, exclusively and regularly. Those are important. Another important thing, if you are an employee, if you get a W-2, you cannot deduct a home office. Sorry. It would be nice if you could. And before 2017, you could. One of the big changes of the new tax law that passed at the end of 2017 was employees, people who have a regular job with a W-2, they cannot deduct any business expenses. Before 2018, you could. And then it was kind of weird because all of a sudden, shortly into that new law, it was 2020, we had the pandemic, everybody had to work at home. Sorry, if you had a regular W-2 job, your home office expenses were not deductible, even though you had to work at home. That was an unforeseen and unfortunate thing that happened. So if you are self-employed, you may be able to deduct a home office. If you have a day job, you cannot. Okay, that's important. Home office examples, you get to directly, these are direct expenses. If I have one room that's my home office and I paint or carpet it, I'm going to deduct the entire cost of that painting and carpeting because I just did it to my home office. But if I hire a house cleaner who cleans the whole house, I'm going to deduct maybe that 10%, or maybe it's 25% or whatever. You get to deduct a percentage of your rent, percentage of your mortgage interest and property taxes, percentage of utilities for the whole house or apartment. If your home office is 10% of your apartment, or maybe it's 30% of your apartment, and you pay, $10,000 to the electric company, 3,000 of that is tax deductible as an indirect expense. You fill out Form 8829 for business use of your home. Now, a home office cannot cause a loss. You can only take the home office deduction up to your business's net income. However, if you legitimately qualify for a home office deduction, I strongly recommend you fill out the paperwork every year and keep track of it. This worked for me. For a number of years, I had a small business on the side where I didn't earn very much money, but I had a home office and I used it regularly and exclusively for that business. Because I usually did not have much income, I couldn't write off all of my home office expenses. But then I was hired by a company as a freelancer, as an independent contractor, where I had to work at home. I got a large income from my business, and all of a sudden I could use up all those stored losses created by those years of tracking the home office deduction when I made very little money. So all of a sudden I got a big income as a freelancer, and I had all these stored up expenses that I got to use to reduce my taxable income. So I strongly recommend, if you qualify for the home office deduction, keep track, keep excellent records, follow all the rules, and fill out the forms every year, even if it doesn't seem worthwhile along the way. Once again, there is an IRS publication, number 587, has all the rules for the business use of your home. If you're considering doing it and you're not sure you qualify, do look at the rules because it matters. Yeah, I cost this out. If you're an employee with a home office, no longer deductible. Okay, business meals and entertainment. Next big topic that causes a lot of confusion. One of the reasons this causes confusion is this is one where they change the rules every year. This doesn't change just because a big new tax law came out. It's really quite difficult to stay on top of this. I was researching it last night to make sure I had the latest. This is also for self-employed people only. Okay, so if you feel like, oh, my job is really inconvenient, I have to spend a fortune going out to lunch every day, and my employer won't help pay for it, too bad. You may need to bring your lunch. If you're a W-2 employee, business meals are not tax deductible. So self-employed people only. For a while, especially I think to help restaurant owners during the pandemic, for a while we could deduct 100% of business meals. Not anymore. We're back down to 50%. You can deduct 50% of a business meal if you're doing it for business development, you're meeting with clients or customers or prospects, or if you're traveling for business and you have to eat along the way. Meals must be in a restaurant. The business owner must be present when the meal is consumed. The expense cannot be lavish or extravagant under the circumstances. That's a little vague, right? You may not be able to take someone out for a super fancy meal if you want it to seem reasonable and not raise eyebrows. But it doesn't mean it has to be hot dogs from a cart either. It's whatever is normal and appropriate in your business and under these circumstances. Not deductible sporting events, tickets, entertainment, things like that. If you have, let's say you're trying to sell a house to someone, you take them out to dinner to talk about the house, deduct 50% of that dinner. But then if you take them to an ice skating show or a ball game or a theatrical performance, sorry, the theater tickets and the ball game are not deductible, even though you're still entertaining that same client. One more caveat, business meals and entertainment change frequently and they're confusing. So if you're confused, check with a tax pro, and again, record keeping. Always keep track of your business meals. I would save the receipt from, if I take someone out to dinner to talk about business, save the receipt, but you also jot down in your diary or your business notebook or whatever, jot down where you went, why it was a business meal, what did you talk about, who was there. Keep those kind of notes in case questions are ever asked, because they can be about things like business meals. Okay, so as much as possible, these are some pro tips for self-employed people. As much as possible, if you're doing the Schedule C, organize your expenses into the categories listed on Schedule C, if you can. You can use the other, but try not to put big unidentified amounts under other. Save all your receipts, even if you're not sure something is deductible. Doesn't hurt to throw them in a shoebox in case somebody asks, or if you're tired of shoeboxes and clutter, or you don't have a storage space. A few years ago, I invested in a good scanner and I love it. I just scan anything I think might be important. Then it's in a folder on my computer in case I ever need it. If you're going to take a home office deduction, follow the rules. Those are scrutinized, but they're also valuable. Consider taking the standard mileage deduction, much easier than the other version, and keep a written record of all business miles deducted. Somebody says, so an S Corp cannot deduct meals. I don't think that's true. I think an S Corp can deduct business meals. Oh, I think I see what you're getting at. Okay, I think the reason the person is asking this, S Corps are a little weird because when you own an S Corp, you are both an employee and an owner. You have to get a salary. But I think it's you that's the owner that's taking someone out to dinner. So I'm going to put that in my notes to check for sure later. But yes, I do believe an S Corp owner can deduct a business meal because they own the business, even though you're also an employee of that business. S Corp's business meals. Okay, Keep your documentation. I've harped on it, but I can't harp on it enough. This is the Tooth Fairy, by the way, flying away saying I'll be back at the end of the year with the 1099. All right, these are types of documentation. These are all helpful. Receipts, invoices, obviously real estate closing documents. You probably know that. I've had some clients who sell a property and throw away the documents. Not helpful. Credit card statements, diaries, logs, and witnesses. This last item is not the most ideal, but it's better than nothing. You know, let's suppose you get audited. You say, yes, I spent $100 on this business meal. We talked about such and such. But sorry, I didn't save the receipt. But maybe you can contact other people who were there. A witness who says, yep, they were there. Better than nothing. Okay. And diaries and logs. I keep a little very simple journal every day. I'm going to jot down everything I do, including took so-and-so out to dinner or drove across the Bay Bridge for this or that. A journal, a diary, something you jot down, it's a lot better than nothing. Okay. This is a piece of my professional tax software. This is keeping track of someone's business mileage. Notice I had to say total mileage the person drove the year and the business miles for the year. So one thing I do is at the beginning of every year, I jot down my mileage on my car and the end of every year. You want to know those two things. Like what was the total mileage for your car? Then you want to know what was your business mileage. The software calculates this. I don't have to guesstimate that I drove my car 4% for business. I just say I drove it 295 miles and I know the total car was driven 7,000, so 4%. And then I highlighted this in red. You must check yes to these boxes. Is there evidence and is the evidence written? The answer is no, you can't deduct it. How to track. And I'm seeing in the chat right now, people are offering their own ideas. So I'm going to read you some of those, partly because I know there are certain apps that are specifically for real estate people. And you probably are more aware of those than I am. Someone says Genius Scan is a free app that can scan receipts. I'll add that to my notes later. Genius Scan. Okay. And then someone says notes on your iPhone can also scan receipts and documents. That's good. I don't know the process for scanning it. You may want to talk to an Apple genius for that. Oh, somebody says the paperclip icon. Okay, but iPhone notes. I do personally use my iPhone notes just to jot things down. I'm often out running around now and I don't have a pencil and paper like I used to. But I will just go ahead and do a little voice note to myself. Hey, remember to keep track of this, whatever I did today. And I come home and I transfer that. But these are all legitimate. Banks and credit cards, it's good to have a separate bank account. If you want to keep track of budgeting, these are the latest budgeting apps recommended by Forbes for 2026. They like Monarch best. I would say I hear that a lot from people now. I also hear a lot of people use YNAB, that stands for You Need a Budget. These are expense trackers for real estate agents, according to AI. I do not have personal experience with any of these, but apparently these are popular for people in your business, something to think about. I think Mile IQ tracks mileage. The others may track other types of business expenses. Any one you use is fine, as long as you keep track. Whatever method you use, just having good records is the most important thing you can do to come out on top in the audit. It'll also make your life a lot easier when filling out your tax return, so you don't have to guess. Okay. Major confusion, Schedule A versus Schedule C. I think this came up earlier. Yeah. People would say, I'm not itemizing this year, so I'm not going to keep track of my business expenses. Totally wrong thing to say, completely different issue. Itemizing versus standard deduction is for personal expenses. Business deductions are always deductible. So always track your business expenses. This is the standard deduction. This has nothing to do with business. So in 2026, if you're single, your standard deduction is $16,100. If you're married, filing jointly, it's $32,200. This is Schedule A. Whoops. This is, I was trying to make it bigger and I made it go away. No. Here's Schedule A. This is for personal expenses that are deductible. When we say itemizing, we mean Schedule A. Not C, which is for business, not E, which is for rental real estate. We mean A. You'll notice it's a limited list of things. Number one, medical and dental. This does not apply to most people, even though it feels like you spent a lot on copays and glasses this year. Your medical and dental expenses are not itemizable unless they're more than 7.5% of your adjusted gross income. If you have decent health insurance and a decent income, this will not apply to you. You will not get to deduct anything here. This category is the one that's maybe changing this year, taxes you paid. So your California state taxes go on this line, your real estate or property taxes go on this line. And then even if that said $600,000, the last few years, this line would say 10,000. You were limited to 10,000. This year, you may be limited to 40,000 or somewhere in between. That can be very helpful. Then we have a new category for home mortgage interest. That you'll notice is not part of the SALT limitation. If you itemize, you get to deduct all your home mortgage interest up to a mortgage of 750,000. Then you have your charitable contributions. The next two little categories don't really apply to most people. In fact, very rarely. So gambling losses is one of them. So your gifts to charity count if you itemize. But fortunately, starting in 2026, you get to take $1,000 of charitable gift contributions, even if you don't. But these are the only things on Schedule A. These are the only things that you're comparing to your standard deduction. So if you don't itemize, you still get to deduct your business expenses, your rental real estate expenses, your self-employed health insurance. You still deduct your retirement plan contributions and lots of other things. Other questions? Oh, here we go. Finally, I wanted to tell you this. May 7, 2026 at 10 o'clock a.m., we're going to talk all about retirement plans for people with jobs, for people who are self-employed, for people who are self-employed or unemployed, but they have a spouse with a job. We're going to talk about Roths and pre-tax and self-employed plans and conversions, everything you want to know. May 7th at 10 o'clock a.m. I hope you'll put it on your calendar. I hope you'll join me. I'm peeking at your questions again. Someone wrote, would it be possible to put a copy of the slide? That person was late. It's okay. We don't know who they are. But as we said in the beginning, Elsie and I will collaborate as soon as we're finished here. I'm going to give her a version of this to send to all of you. So you will get my notes. So no need to ask that question again. While I go through this last part, though, we're down to about our last 15 minutes. So if you have any questions, this is a great time to put them in the chat or to raise your hand, and we'll try to let you talk out loud. Meanwhile, while you're doing that, I want to share some extra resources. If you need help with your taxes, and a couple of times today, more than a couple, I said, oh, with that issue, I'd talk to your tax professional. If you need help and you can't afford a tax professional, the IRS VITA program, that stands for Volunteer Income Tax Assistance, they will help you if your income is less than $69,000, or if you're disabled, or you have limited English. There's many very good volunteers doing that. So, and there's many locations. If you think you might qualify, contact VITA. If you need help and you don't qualify for that, consider AARP. They have a program called Tax Aid. AARP, as you know, is the American Association of Retired People, but you do not have to be old to qualify for this. You don't have to be poor either. There are some limitations. Somebody told me, oh, because I had an LLC, they wouldn't help me or something like that. But I check on both of these if you need help and you can't really afford it. They're great volunteers. Also, the IRS offers a free file system. If your income is $89,000 or less, you might be able to use their system. This won't get you a person, but it will get you a program so you don't have to pay for TurboTax or H&R Block. What else? Oh, on my website is clarityfinancialca.com. First thing I want to stress is I'm not trying to send you there to drum up business. I'm not taking new tax clients, and I'm quite busy. So I'm not here today to get more business from you. I'm here today to help you, but there are a few documents there that you might find useful. The first one is tax return checklist for do-it-yourselfers. On that, I've kept track over the years of things that people who use TurboTax or do taxes on their own, mistakes that tend to come up, maybe things that aren't written as clearly in there as they could be. So you might just, if you do your own tax return, you might just want to download that list and check through and say, yep, I did that, I did that, I did that. Okay, I also have one called How Not to Mess Up Your Backdoor Roth and one called Should I Roll Over My Old 401k? You're welcome to download those 3 PDFs. I do not steal your information. I do not do any marketing whatsoever. So don't be afraid to visit my website if you want this information. If you need a tax professional and you can't find one, the irs.treasury.gov will help you. You can see their credentials, find people in your area. These are key numbers for amounts of contributions and income limits. And if you need a financial planner, these are some good places to look for those, or a financial advisor. The Certified Financial Planner designation is good. The Financial Planning Association, FPA, can help you find somebody. The Garrett Network can help you find planners who do work on hourly basis instead of taking a percentage of your assets. Let's see. And that's just me again. I'm going to leave this up and look at your questions. Let's see. Somebody says 14A and 14B review. And then it says, why say yes? Off the top of my head, I don't know what 14A and B are. Could somebody put a quick note in there to tell me that? Chances are it's something we covered, but I don't know it by that term. I'm going to Google it on my phone, but if you could also, maybe the person who wrote that, tell me more specifically, what do you mean by 14A and 14B? Aha. Okay, it says, can I claim it on my taxes and additional contributions? It says employers can put just about anything in box 14. Oh, box 14 on the W-2, right? It says you'll need to ask your employer what these deductions are for if you're unsure. What I'm reading right now is on my phone, a TurboTax Q&A about this. It says ask your employer. It says you can count the amounts in box 14 on your W-2 if they're for a qualified retirement plan. So sorry, I'm not sure off the top of my head what 14A versus B is. But I like that advice to check with your employer, because if it's on your W-2, they're going to be the ones who filled it out, and they will know why they used one box versus the other. I'm seeing some nice notes that say thank you, which is nice. And I see Elsie posted the information about signing up for best retirement plans. Believe it or not, that class takes about as long as this one, or can. There's so much information about retirement plans. They're incredibly valuable, even though they're complicated. So it is worth learning more about them. Oh, somebody said, please let us know your website again. Go back there. Here we go. Clarity Financial CA, as in California.com. Okay. You're welcome to visit anytime. And someone wrote QBI. QBI stands for Qualified Business Income Deduction. And I'll tell you, if you want more information about that, I could provide it, but it gets very complicated at the higher levels. But at the basic level, QBI is a 20% tax deduction on earned income from people who own a small business. It applies whether you are a sole proprietor, an LLC, a partnership, or an S Corp. It applies to all those people. Does not apply to giant corporations like Apple and Google. It does apply to all pass-throughs. It saves us 20% on our taxes, on our business income. So it's very valuable. Now, it can get more complicated at certain levels. Like if your business is earning a ton of money, and by a ton, I don't remember the exact number. Let's say if your business is earning more than $500,000 a year, then you might get more value out of the QBI by forming an S Corp. That, as you can imagine, is a complicated topic. And I'll tell you, one time another group of realtors hired me and specifically asked me to come talk to them. And the topic they wanted was called QBI in the real world. So I developed a presentation that was about all the complications of qualified business income deduction. And they did not enjoy it. They supplied me with the topic, but all the feedback I got was, that's too complicated. We don't know what this is all about. We don't even have retirement plans. Why would we want to know how our retirement plans affect QBI? And I realized it really was too advanced for that situation. So what those people, that particular group of realtors, you're probably more sophisticated. that particular group, most of them did not even have a retirement plan set up. And it's important to do that first, before we talk about like, how could you strategize how to maximize your QBI in addition to your retirement plans. At the high levels of high income, there are some strategies, but the first thing is build your business, earn good money, and save money in a tax advantaged retirement plan. Okay, I don't think I'm seeing any new questions. So if there are no more questions, we're going to go ahead and wrap up in a minute. You'll notice I'm talking and talking. You're welcome to type in questions while I do that. But our next plan is, I'll wrap up in a few minutes. I will proofread these and check on one or two things that people asked about. And then I'll produce a PDF of this. I'll send it to Elsie. She will distribute it to you. And I very much hope I'll see you on May 7th. As you can see, I enjoy questions. So if you have questions about your retirement plans, feel free to kind of organize them before May 7th and come prepared to talk about that. And then I'll go ahead and wrap up. Elsie, should I turn it back to you? I'll stop sharing. Okay, thank you very much, everyone, for coming. I'm going to go ahead and leave the room. Have a good afternoon.